Welcome, everyone, to this legal office hours. Today's topic is all the employee issues that come up when buying a business. My name is Will Smith. I'm the host of the podcast Acquiring Minds. Attorneys James David Williams and Bill Barlow are going to host this session. James David and Bill are, of course, the partners in Barlow and Williams, a practice that specializes in small business M&A. They see tons of deals. They're at the front lines of this market. Their focus is helping searchers, sponsors like you all do your deals safely and to your advantage. They also represent sellers, so they understand well both sides of what goes into an acquisition transaction. This is their 9th office hours with Acquiring Minds. You really ought to go back and watch their other sessions, all of which are recorded and available on the Acquiring Minds website. I'll provide links to all 8 of those here in a sec. This body of webinars is really a masterclass in the legal aspects of buying a business, a huge amount of value across these 8 and today 9 webinars. A couple of things before we begin, usual logistics. The way we do these is that Bill and James David will give their presentation, and then we'll do Q&A. To ask a question in the webinar version of Zoom, which you're now in, there's a Q&A button. Use that. You'll note that chat is turned off. Don't use the raise your hand thing. Use the Q&A button. Sometimes somebody will have a live deal or a complicated situation, can be very detailed, very in the weeds. And so it's a bit difficult to ask those in real time for everybody to wrap, for me, and then for everybody to kind of wrap their heads around. Ask those anyway, because Bill and James David can reach out to you after the fact to answer personally. So don't hesitate at asking too complicated a question if it doesn't get answered here. You'll hear from Bill and James David after the webinar. We are recording, and you will all receive a link to the recording and the deck in an email in the next day or two. And finally, the socials and website of James David and Bill are right there in your chat. Connect with them there. Go to the Barlow and Williams website, where you can also find their webinar content. But here it is as well on the Acquiring Minds website. That was just a big post in your comments or in the chat. All 8 of those webinars that they've run. Great. Bill, James David, over to you guys.
All right, let me set up the screen share, and then, all right. So, and just to add a little bit to what Will said about sending questions, if you do send a question, make sure that you're not anonymous, because if you're anonymous, then I can't reply to you. And if you are anonymous, send another question that includes your email right after that. There have been a few people do that. Anyway, so we are Barlow and Williams. We are a 2-person M&A law firm. All we do is help people buy and sell businesses, whether that be in the SBA range or above that in the independent sponsor range. We pride ourselves on our flat fee pricing model, and we use milestone-based payments. So happy to explain that later, but for now we'll jump in. So the purpose of the topic for today is employment, or employee considerations, employment issues when buying a business.
All right. So I want to start talking about the beginning of the process. So after you have looked at a SIM, even at that point where you're reviewing a SIM, one of the questions you might ask yourself is, who are the key employees? What does the organization look like? Partly because you want to understand, you're replacing the founder, and you need to understand if you're able to fill that role or what other employees can fill that role. But you also want to understand about the key employees of the company. So key employees are people that are critical to the operation of the business. If you don't have them, you're going to have lots of trouble. This can be because they have relationships. they have specific relationships with customers. This can be because they have unique skills. They know everything about, how to do certain manufacturing things or service things that the business requires. The reason you want to know this is because you need a plan to retain these key employees after closing. One thing that we find is a really, not always, but is often a big sticking point with sellers is when does the buyer get to talk to employees, especially the key employees? We've seen things from buyers be able to, meet with them right around the time of signing the LOI. So you've got a long time to meet with them, discuss with them. We've seen sellers that are basically want you on the day of closing to walk in, introduce yourself and say, I'm the new owner of the company. Obviously, as a buyer, you want to have some time before that where you get to talk to the key employees, get a sense of the key employees so that you can build a rapport with them, and also that you can know that this is going to work going forward. Other things that you're going to want to know about in diligence are just sort of basic things like who are the employees, what is their role, how are they being compensated, hourly or salary. Something along those lines too as well is W-2 versus 1099 classification. Oftentimes, there can be misclassification problems where there's actually a W-2 employee that's being treated like a 1099 employee. And even if you're doing an asset purchase, those are the type of liabilities that can, employee liabilities can often transfer over. And so, that could create a lot of liabilities because for a W-2, you're supposed to be withholding Social Security and, all of those other things. So that's something to keep in mind. One other thing I'll mention here with employees is their legal status. So you will ask them to provide I-9s, which is basically proof that the employees have the right to work in the country. And obviously in the current environment, that's increasingly important to verify that. You also just need to know what are their what are their benefits program, what are their equity incentives. Obviously most employees like to maintain those same programs in general. And sometimes if employees have existing equity, they might actually be getting a fairly substantial check at the closing of the transaction. And you want to be aware of that because sometimes people that get paid like $100,000, might not be as motivated than people that are still hungry to, get their next paycheck, etc. And a final point I'll note is accrued vacation commissions and bonuses. This is very common where you'll have long-term workers, or maybe you're closing in the middle of the year and they have accrued 15 vacation days, 20 vacation days, whatever it is. And they're going to expect that they have the ability to take those vacation days. So in theory, the day after closing, they could go on vacation for 3 weeks and you'd still have to pay them, right? And so that's why you just want to make sure you understand that, pay them out, or find some other way to deal with it because, from the employee's perspective, they're going to expect that everything they had before is just automatically continuing on.
Okay. So I'll talk a little bit now about the tough conversations that happen on day 1 or day 2 or maybe day 3 of ownership. So what happens whenever there's a new boss is you can kind of expect a parade of your employees to come into your office and ask you for a raise. And that can be a hard conversation to have, especially
or a loan or a personal loan, right? Sorry, but that happens. We hear about that too.
Okay. I mean, you'll have conversations, right? I mean, you'll want to meet with your employees regardless. And so I expect just as part of this, right? Don't be surprised by anything, frankly. But the most common thing is they're going to talk about compensation, right? And raises. And you'll have a sense from the diligence, hopefully, of what they were making before. And it's possible that you just kind of build into your model that you're going to give people a raise, right? Sometimes that's necessary because they weren't being paid enough by the prior employer, right? So that is something that you need to be careful of in your financial modeling. Like if you expect to need to give raises to people, you need to build that in because that's going to affect your cash flow. But a few ways to sort of have the conversation. I know of some people who have bought multiple businesses now, and what they do is just announce on day one that compensation will be frozen for 6 months. And just a blanket company-wide announcement that this is how it's going to be. They will often and that gives you enough time to sort of understand like who's really a key employee, what compensation types does this person want, does this person want, does this person want, etc. One of the powerful tools along with that is to use the performance bonuses or retention bonuses. So something like a retention bonus would work something like this, right? If you are still here after the 6 month period, I would just say 6 months, we're doing a compensation freeze. If you're still here at the end of that, you'll get a bonus of, X% of your salary, X dollar amount, right? You can decide what those are. That can be a nice way to decrease the chance that a bunch of people just walk out on you day two, right? Because that's really not what you want most of the time when you're doing an acquisition. And performance bonuses are a little bit tougher to do it right at the start, just because you don't necessarily know what the key performance metrics are for the different roles, which is why I like retention bonuses. But it's a conversation that you are going to have, right? So there's several different ways you can approach this conversation. I like some of the blanket stuff, but if you're not ready, if you're caught off guard, then there's a real chance the employees are either going to try to just take too much from you or just not respect you, right? Because this is one of the key early conversations with your new employees. So you need to be ready because you've got to earn their respect or you're in trouble.
The next thing we're going to talk about is equity incentives. So this essentially is giving employees upside in the company. There's a couple different ways to do this. One thing we're going to note here is that there are lots of important tax things related to giving employees equity compensation. So you want to be careful here. So I'll just give you an example. Let's say you bought a company for $1 million and you decided that you were going to give 1% of that company to an employee that you wanted to incentivize. If you simply gave 1% of that equity to that employee, that would be treated from tax purposes as if that employee had received $10,000 worth of income. That's 1% of $1 million. So the employee on their tax return has to report $10,000 worth of income, but they don't actually have cash, right? They have this shares, which may be worth something or maybe not worth something. So they're going to then have to pay taxes on that, as if they had had $10,000 of cash income. They might be upset about that. And so you have to be careful, and you have to be careful about tax whenever you're structuring this. And that's why a lot of times you won't give them straight shares. You'll give them things like warrants or options or profits interests. These are things that all basically mean the same thing, but depending on the structure of your company, you'll use different terminology. And how that works is instead of giving 1% of the value of the company, you give an option to buy 1% of the value of the company, and that will be worth more. Let's say that the value of the company goes from 1 million to 2 million. They might get 1% of all the upside above $1 million, for instance, and you can do that in a very tax efficient way. You should just know that there are some things you have to do in order to do this. Sometimes when you go through a sale process, it's truly third party, you can sometimes forego the valuation, but oftentimes, especially after the initial sale, you need to have a valuation to determine what the value of the company is and the shares are at the time of granting. And just know there's some things called 83B filings. there are some very strict requirements, and this can get technical and we're not going to go into all the technicalities, but there are some very strict requirements of things that employees have to do in order to make sure that their equity is taxed appropriately. This is true if you want to vest equity. So vesting equity is basically when you don't give somebody equity all at once, but you give it to them over time. So taking the previous example, let's say you had an employee, you want to give them 1% of the shares of the company. Well, just handing over 1% of the shares and saying, you know, I like you, is not always the best approach. A better approach is often to say, I'm going to give you 1% of the shares, but you're only going to get it after you work for me for a certain amount of time. And, you know, the longer you work for me, the more those shares vest. And if you leave before those shares vest, then you lose those shares. So that lets them know that they're going to get upside in the company, but also it makes sure that they're going to stay with the company so that they get to keep that upside. So keep in mind, these are all things to talk about with your attorney, but they're, you know, they effective incentives and they affect tax, and there's some very strict rules about making filings that you have to worry about. The other thing we'll note with employee equity is that you probably want a game plan for what happens when they leave. So you might like an employee, but once they've left the company, generally you don't want a 1% shareholder that's kind of straggling along. That might be a problem if you sell the company, you know, might, you know, just create headaches. So in general, you want the ability, and frankly, they often want the ability too, that if they leave the company, you can buy back whatever shares they have so that you can just keep a clean cap table going forward.
So I'm going to talk a little bit now about non-competes, and then Bill will get to talk about non-solicits. So non-competes, there are really two flavors of non-competes in regard to business acquisitions. There is the non-competes that your employees have or may not have, and then there's a non-compete with the seller of the business. So I'll talk about, despite what these, I'll flip the order. For the sale of the business, in any state in the country, no matter what anybody says, you can have a non-compete in place. Now, that doesn't always extend to the person, to the seller's family, which can be an issue, but the seller himself or herself, right, you will be able to enforce a non-compete against them if you buy a business from them. It'll have to be crafted in such a way that it's only a certain number of years, and that depends on what state you're in as to what's permissible there. The geographic extent, which often is sort of where the business operates at the time of sale, and then defining what the competing business is, which is basically what the business does, right? Because if any one of those requirements is too broad, then the non-compete can be, you know, stricken by a judge. You write in particular language that has the judge actually rewrite it instead of just getting rid of the whole thing. But still, you want to be tight with these. And frankly, if the seller is pushing back on a reasonable non-compete, that's a problem. Just as a, not always with defining business or with competing business, because often you will carve out other business activities that the seller has, right? That's okay. Have that conversation. That's part of why we talk about it. But if they're pushing back on the time restriction, like you want it to be 5 years, they say, no, I'll give you 1. That could be a problem. Or the geography. Like if you're in a certain state, but you're also in the next state, and they're like, no, I'm not, I'm only going to give you the home state. Like those things should be sending off alarm bells. Now I'll talk about employee non-competes. This is very much in flux. So historically with employee non-competes, it was a state-by-state determination as to what's enforceable and what's not. California is famously anti-non-compete. Other states will enforce them. Towards the end of the Biden administration, the FTC promulgated a rule that would effectively ban non-competes for employees. There are a few limited exceptions to that, but we'll just ignore those and just say it was an effective ban. That ban was then challenged in court in multiple places in the country. There were actually some rulings in favor of the FTC, some rulings against it. It's now on appeal in the 5th and 11th circuits. So in those cases, judges at the district court level ruled that the ban on non-competes was arbitrary and capricious, and so should be discarded. So that's currently being litigated now. And within the last couple of weeks, under the new administration, the government has actually requested a stay in those proceedings. So it is entirely possible that in the coming months, it will be announced that the FTC is effectively pulling back that rule and won't try to enforce it. If that happens, and again, as of March 13th, when we're recording this webinar, that's not the case, right? It's still a live issue. But if that were to happen, and the government and the current administration decided not to enforce this, and potentially even implement a new rule to discard the old one, but we'll see, then it would shift back to a state-by-state determination as to what is appropriate in an employee non-compete. And you can expect quite a bit of movement from various states if that happens, probably in favor of employees, but we'll have to see. But that's very much, so employee non-competes very much a live issue, and not really certain where that's going to be in 6 months, much less 12 or 24.
And then we're going to talk about something that often gets lumped into non-competes, but are actually a little different, and those are non-solicits. So think about it this way. Let's say you had a business that was in an area, and that business had 50 customers. Let's say it's a business that's an HVAC business, right? If you had an employee, and the employee, you might want a non-compete that says, if you leave, you cannot work or start another HVAC business in this area, right? Again, that may or may not be enforceable. But you might also say, you cannot solicit the customers that we have as a company that were there when you were an employee. And so in many ways, the non-solicit is actually quite powerful for two reasons. Number one, it's often protecting what you care most about, because what you care most about is your customers leaving for this other person and employee. That hits revenue. So in many ways, non-solicit protects really the core. And secondly, it's a lot easier to have a non-solicit with an employee than a non-compete. So you want to make sure that your employees have those non-solicits so that they can't, even if you leave and start a competing business, that competing business is not soliciting customers. It also can apply to employees. So like, I want to leave and start my own business. I can't turn around and try and hire employees of the company to join me at that new venture. Suppliers as well, although that's generally less often an issue unless there's some sort of exclusive distributorship reason. There has to be a time limitation. So just like a non-compete, you can't just say forever and always, you will never talk to any of these people. But if you put in, a time thing, that can be very, very protective. Because think about it. If you have somebody that's an employee, they have these great customer contracts. If they're not allowed to talk to your customers for 2 years after they leave, well, by the time they get back around to it, those customers might have adjusted to somebody else at the company. That relationship will not be as strong, so it'll be harder for them to pull them over. So just keep in mind, non-solicits are a really great tool. And even though non-competes often get the spotlight, non-solicits are actually a lot of where a lot of protections really come in.
Okay, so that's the end of the presentation. It's a little shorter than last month, so it's good. So, uh, yeah, if you have questions, go ahead, start adding them in. I'll say, and then we'll review them. I'll say on the non-solicit, right? You can't stop the customer from reaching out to that person. Right?
Yeah.
It's only a one-way stop, that you can stop the former employee from reaching out to them. So like it's not completely bulletproof, but it's still a very powerful tool and will be enforced much more broadly. So again, we are Barlow and Williams. We do M&A exclusively at this point for businesses in the SMB and lower middle market space. We operate on flat fees, milestone-based payments, and when you work with us, you work with us. It's just the two of us. So that said, people sometimes ask about our capacity. Like if we're allowing you to meet with us as a prospect, then we have the capacity. So we pride ourselves on our efficiency, and capacity constraints have not been a problem thus far. So maybe it will at some point, and that would be a good problem to have, but that is not one of the problems I face today. So
And then I'll also just say, we are also happy as part of this is sort of general office hours for you. So if you have questions on employment issues, great, we're happy to field them. But if you also have just general legal issues, again, we're happy to have them, happy to talk about anything.
Thanks, guys. And I'll personally vouch for your responsiveness. I feel like whenever I send you an email, within 5 minutes, I have a response from Bill. It's really quite something, and makes me feel
it's a problem.
it's well, it sure makes me feel like I need to up my game. Great, guys. Well, we got just a trickle of questions during, so I think everyone was paying rapt attention. Now they're starting to flood in. Let's go to, just to be absolutely clear, I think it is, or it's implied, but when we're talking about non-competes, non-solicits, this is for an employee who starts a business, a competing business, as opposed to just working at a competitor.
no, it would,
Oh, sorry.
yeah, it would still apply if they worked at a competitor.
Okay. But a non-compete means starting a business.
No, it can mean both.
Okay.
It can apply to starting and working,
Okay.
which is why some states don't like them.
Okay. Yeah, because you're basically barring the person from any activity in the whole industry.
Yeah.
Within the geography, within the time frame. Yeah.
So that's why you want to be narrow with them, so that they'll actually be enforced.
Okay, super. Let's get into it. We'll go back to the top here. Buying a business in an industry that frequently misclassifies 1099s. So back to slide number 1. What risks and challenges should I expect when I move about 25 people who are misclassified under the current ownership as 1099s into W-2 employee status under my ownership?
So one of this relates to what type of purchase you're doing, right? Because if you are doing an asset purchase, the nice thing is that you're a whole new entity, right? And so the IRS might not be seeing quite as quickly what you're doing. If you're doing a stock purchase, at which time just know that you will probably invite extra scrutiny. Now, this is one of those things where the audit risk on this is very unknown, right? Like, it could be a problem or it could just not be an issue. And, the bigger the company, the more the employees, the more likely it is to be an issue, right? And so, but I would just say as a general practice, what you should do is you should start classifying them correctly going forward. and you should have an indemnification, maybe even a special indemnification, that if this becomes a problem for you, then the seller is going to have to pay for any, consequences that result of prior misclassifications.
Because the sorts of things that could result in misclassifications. I mean, you could have fines, right? It's withholdings, and then you have penalties over top of that. It could be bad. This also applies to, wage and hour issues. Like if the people weren't paying wages on time, or were skimming tips, or whatever else, right? All these other things could also carry over. What happens, even in an asset deal, and it does vary a little bit by state, but the way it generally works is if you hire, you rehire substantially all of the workforce of the prior business, then that liability is going to carry over. Because states don't want you to just be able to shed that liability, because otherwise bad actors would just form a new company every couple of months. So that there is some carryover there, but it's not just the classification issue. It's also, paying wages on time, not skimming tips, whatever the issue is with the business. You want to make sure that those are proper. But regardless, do it right going forward, and get indemnification if you find a problem looking back.
Since deals are usually cash-free, debt-free, how do you ensure that you get that the accrued liabilities, like the salaries, bonuses, commissions, are ported over? Do you specify that you're kind of like, do we treat it kind of like AR, AP, inventory, working capital, just another bucket there of kind of something that needs to be pegged or understood and carried across?
Often they're just paid at close. Often it's just paid out and zeroed out. But yes, it would be, right? These accrued, they're all just liabilities on the balance sheet, right? So it would kind of get lumped with accounts payable in a net working capital type calculation. But often they're just paid out at close.
Yeah.
Great. That was the question. How do you port them over, or do you? And it sounds like often you don't. The seller pays them.
Sometimes, but it can be a little tricky with vacation, commissions and bonuses, not so much. But like some people like that they've had vacation accrued. So if that gets paid out, then they start again at zero. And like if they had a summer vacation planned and you're closing in June, so you can kind of massage it sometimes. And sometimes you would just allow it, you just credit it and then just take the money off the purchase price. It can get a little bit messy, but you account for it.
Mm-hmm.
Most of the time, employees that have accrued a lot of vacation do it just because they habitually don't take vacation, which, maybe they should. But usually those employees, if they have like 20 days, are usually happy to be paid out, because it's rare that they have a plan to take that much time. But, yeah.
And I'll also add, accrued vacation is not, right? It can vary state by state as to whether that is earned wages or not. Right? So there is a little bit of complexity there. But even if it's not earned wages, I encourage you to honor the accrued vacation of your employees, or you're going to have some very mad people. But it is a little bit state by state nuance. So yeah, more complexity from a lawyer.
Some businesses require trade licenses, something that comes up a lot, and so many blue-collar tradesy businesses are required here. If an employee is willing to hold the license for the company, even temporarily, what are some ways that I, as new owner, can handle that? Are there contracts or special incentives that need to be put in place for a situation like this?
So I'll say a couple things. One thing is, you definitely want to be talking with your lender about what they're comfortable with, because oftentimes lenders might not be comfortable even if you are. The second thing I would say is that, the usual things apply. So if you really need to have somebody around for 6 months or a year, then you can give them an extra incentive to stay around for 6 months or a year. And I would also say make sure you have a game plan, because even if your employee is fully on board with being a license holder, they could get hit by a bus. Bad things can happen. And so you have to have redundancies and backup plans so that if a key employee, heaven forbid something happens to them and they're the only license holder, like you have to have a plan in place, or you should have a plan in place, I should say, for what you're sort of going to do in the interim.
Great. Question from me. James David, you talked about the handling compensation requests in the parade of people coming through the office on day one asking for a raise, and how you see buyers, now owners, do the announcement of 6-month freeze on salary adjustments, i.e. raises. That seems clean and, a great way to control the situation. Is there any downside? Have you heard anecdotally that employees don't like that? I mean, why not do that? That seems like a really clean way to handle it.
Yeah, I mean, I will say we don't, small sample size in data that I have on this, we don't often hear what happens in some of these conversations. I mean, you can do this. It's still not going to stop the conversation, right? The employees are still going to ask. And I think it probably does cause some grumblings among some who have feel like they've been underpaid.
Yeah.
But again, and it doesn't have to be 6 months. Right, I've heard of 3 months. I've heard of 12 months, right? I've heard of a range there. You could even do it for just 1 or 2 months, frankly, because that'll give you enough time. You want to buy yourself time with something like that. So really 2 months is probably enough, and short enough that the grumbling would be to a minimum. But yeah, to answer the specific question, I don't have a lot of data of people who do that and what happens.
Well, I too have heard more than once of this technique, and it always struck me as a good way to handle it, assuming it doesn't make everybody matter. So
I have one other thing. It's not exactly related, but something that could be brought up relates to the fear that employees leave right after closing. And one thing I'll just state is we've had occasionally buyers say, I'm so afraid that I'm going to step in and employees are just going to leave and I really need them. I want the seller to indemnify me if the employees leave. That often doesn't work. I've never seen a seller agree to it because effectively the seller is worried that the buyer is just gonna do something that will make the employees angry. So just keep in mind that as you're having these conversations, it's very important to keep the employees happy post-closing, and also just know that you're probably not going to have very much in the way of protection from the seller if you do something that will make the employees angry and then they suddenly decide that they don't want to work with you. So
since we're talking about this, on my little joke, which is I've heard many times about day one, employees come up to you and literally ask you for a personal loan. Maybe not day one, but you get requests for a personal loan or a prepayment of salary, I guess is really what it is. I actually don't know if it's a hard no. I get the impression that buyers, now owners, actually sometimes say yes. Any best practices there?
Sadly, no. I mean, if you're going to do it, make sure it's all written down.
and the other thing is, and this is honestly a good thing to say when you're loaning money to family members and friends, like assume that money is out the door, right? I mean, obviously you're gonna be able to take it out of the next wages or whatever, but you should not be assuming that like you should plan as if that's going to go wrong.
Yeah. Which introduces not, more complexity, not just, oh, now you're out the $1,000 you lent, but also does it create some weird dynamic with that employee that like they know they know that they owe you money and haven't paid it, and do they resent you for that as they're now debtor? Yeah, delicate. Okay. What about a non-compete for a key employee that has phantom equity? So I guess seller, previous owner,
Yep.
has granted phantom equity to this key employee, and so therefore that key employee is going to get a significant check upon your acquisition, so that the sale to you. Do they fall under the seller's non-compete? Because
I wouldn't rely on it. Phantom equity is a contractual right. It's not right. I mean, it's not equity, right? Phantom equity. But what phantom equity is at root is a contractual right to payment, same way an employment contract is. So they're not an equity owner. So you're in that sort of. I don't think that is enough to attach it to the seller. You could try it, and some states might. This is again state by state. There may be some states that would, especially depending on how much money the person gets as a result of the transaction. Right? If it's a nominal amount, then probably forget it. But if it's real money, some states might, but I wouldn't count.
And you can also have conversations about transitioning. I mean, talk to tax people about this first, but like transitioning some of that phantom equity into actual equity, so that prior to closing, so that you would have somewhat of a better leg to stand on. So we will sometimes see situations, by the way, where you can have conversations if there are people that really need to be restricted by the non-compete but aren't equity owners. You can sometimes have conversations about restructuring the cap table a little bit just to give you a little extra protection for a purpose of a non-compete. So that might be one of the times where you might consider that.
On employee diligence, do you spend any time checking for pending investigations or employee disciplinary challenges?
So when we do the initial diligence request list, we'll ask if there's any sort of problems known with employees. We'll also say, do you know in the purchase agreement, do you know of any potential issues? The issue is that most of the time, if there is an employee problem, it's very rare that it's documented. Very large companies might have extensive documentation when they're having employee issues and, have HR do this stuff. But with these small businesses, it's, a person that comes into their boss and says something and there's words back and forth, but there's rarely a real record. If there is, it's maybe email. So that's not the sort of thing that typically we'll see diligence items on unless the seller proactively raises that it's an issue. So we have to rely on the indemnification of the purchase agreement to kind of bring those issues to light.
And things like EEOC claims take a while to get through before there's ever an official correspondence. Right? So there could be something bubbling, but even the seller may not know. Right. So, but you rely on indemnification with some of that. But if there's official investigations, then obviously you want to know.
Couple quick questions on timing. If you're in a situation where you are moving employees from 1099 to W-2, is there an ideal time frame to do that, i.e., right when you buy, or wait 6 months, or wait until the new fiscal year?
No, you want to do it immediately if you're going to do it, because that will put you on a better footing in case
with the authorities.
You would want to do it immediately.
Great. And then speaking of immediately or not, just generally getting the employee contract signed with employees, with your now employees, day of closing, day one of ownership?
Ideally, it's the same. Yeah. I mean, ideally, it's beforehand, frankly.
You have signatures in place that'll be released at closing.
Hmm.
Yeah.
But if you can't do that, then yeah, you'll present them with their new contracts in sort of the, I'm the new owner, here's your new documents to sign.
And sometimes that has to be done delicately because, a lot of times employees are like, oh, I just met you. Now you're putting this legal document in front of me.
Yeah.
So, just keep in mind, and often the seller can be a great resource. We're actually discussing this on a deal this week. The seller can be a great resource to be like, how is this employee going to react if I, put this document in front of them? And they might be like, oh, they'll be more than fine, or they might be like, oh, this employee is going to like, get really nervous and whatever. And so, use that as a way of gauging what the best approach is.
Someone says, I missed it. Is it common that non-solicits are signed by employees after acquisition to protect business customers versus just the owner or equity holders?
Yeah, I mean, I would put it in my standard employment agreement.
So everybody at the acquired business is covered under the non-solicit.
Yeah, I mean, it could look a little bit different. The time period, frankly, will be longer with the seller, most likely. But I would make it part of it is part of our standard employment agreement that there's a non-solicit.
So this is really a non-solicit is really probably in many employment agreements anyway. It's not something very specific to M&A.
Yes, but you should check for it because not every form you're going to have online is going to have it. And not every form is going to have the specificity that you require. So it is something that is commonly missed.
Interesting, given that you were very convincing in how useful it is.
Yeah.
Any special considerations for a unionized employee base?
This is interesting because we've done some deals where there has been unions. It really kind of depends on the union. A lot of times this will happen if you are, having steel workers or granite workers or like a particular trade. And then you have a union that is just a union for that trade. And you will talk to the seller about how those negotiations tend to go. Sometimes they just have a union rep that comes around once a year, they have a discussion, and then you do that. The other thing I would say is that if there's a specific union to that company, you might need to get specialist counsel to really dig in on that. One thing I'll say, because it relates to unions, is unions will often have employees be part of basically a shared health plan, a multi-employer health plan. This gets into the area of ERISA and benefits, and there's withdrawal liabilities. So there's a lot of different, we're kind of scratching the surface here. There's a lot of different things where if you go down the rabbit hole, you might find things that will create lots of potential liabilities, etc. And most businesses won't have that, but if you have union workers, you might also be part of this multi-employer plan. You might have liability if you withdraw from the plan that would be really large. So just, make that as I definitely need to talk to a lawyer about this moment.
And if there is a union in place, regardless, get it sorted prior to close. Don't leave that till after closing.
Yeah, no.
Sorry. Go ahead, Bill. No, please.
I was just going to say one other thing, and I thought about this as we were discussing potential lawsuits and other things related to employees, especially if we're in the blue collar field, is you want to make sure you look at the insurance, including insurance for, what happens if your employees get injured, because sometimes you'll find situations where the current business does not have adequate coverage for those situations. And so, and if something happens, a week after closing and it turns out your insurance is not enough to cover it, one, that's not going to be the seller's liability, that's your liability. And two, if you don't have enough insurance, then that's coming out of your pocket. So also, if you're doing anything in the trades or, generally anything that involves potential danger for your employees, like really make sure that that's covered. So.
Super. Now, so often in these conversations, we're talking about retention, retention, retention. But the hard truth is that often getting rid of employees is actually something that you perceive even during diligence that you'll want to do. Maybe the seller talks about a problem employee. Maybe you perceive that it's just a very bloated organization. We don't like to think too much about private equity coming in and reducing headcount, but sometimes that is what happens even down here in the lower middle market. So, anything to say about not retention, the opposite? You're in your target acquisition, you perceive that a particular person or a handful of people you're going to want to let go. Does that change any of this stuff?
Yeah, I mean, if you're going to do it day one, do it day one. Right? Just don't offer them a new employment agreement. Right? That's a clean break. It's going to be tough to know that probably, but if you do know it, then just go ahead and be done with it, because then it's not your problem, right? It's the seller's problem. But this is where some of the language in the employment agreements matters, right? Hopefully, and it depends on whether they're unionized and all of these other things. But it could be that you have a not for cause termination on 2 weeks notice, and after a couple months you just say, hey, this isn't working and we're going to cut you loose, right? But I'm not sure I would come in day one and slash and burn. That has the potential to really, one, you could just be wrong about who's actually important, but two, that can really crush morale. Right. So it's another thing where maybe you just take a couple of months and just lock everything in place for that couple of months till you get your feet on the ground planted, and then you make these decisions. But as long as people have kind of at will contracts, you can sort of let them go pretty easily.
I'll mention
it's a tough emotional conversation to fire people, but
yeah.
I was going to say a lot of bosses say that this is the hardest thing for them to do, especially if the employee is in a situation where they don't have many other options. It's very difficult. I would say, best practices is, if it has to happen, be simple and straightforward and direct, be kind, but also recognize that you will likely have to not, usually you have things where, you give them notice or something, but often you don't want them to be in the building or don't want them to have access to email, depending on the nature of the relationship, because people will get into a very emotional state, and people in those states will do things that are potentially harmful for you and the company. And so keep that in mind as you're going through the process. It's difficult to do this, but you do have to protect yourself and your company, if it gets to that point. So.
A question about Barlow and Williams. Can you guys give any sense of dollars and actual dollar amounts or actual fees for a typical deal?
So right now, most of our sort of self-funded search ETA deals are coming in around 20,000. But I will say that that's kind of like that is assuming quite a few things. That is assuming that you don't have equity investors. That's assuming you're not doing any tax reorganization. That's assuming there's, nothing substantially hairy with the business. And to be fair, a lot of these deals don't have that. So we do a fair amount of deals at that price point. But hopefully that gives you some idea about where we'll generally come in at. And then if there are things that make it added complexity, another thing I'll say is if there's a seller role. So if the seller is retaining equity, then you will need an agreement with the seller. And that agreement negotiation is often just as fraught as the negotiation about the actual purchase agreement. So anyway, just a couple things to keep in mind, but hopefully that gives you somewhat of a ballpark of where we are right now. I always say this because we always want to preserve flexibility in case things change going forward. But as of March 2025, that's sort of where our pricing is coming in at.
Great. Very helpful. Well, we are at 57. I think we're losing people because everyone's got to go do their next thing. So we'll do one more question on equity roles here in a minute. But before that, I'm going to put links to all your past webinars there in the chat for anybody who might have missed them when we added them at the top. Did that work? I don't think that worked. There we go. So look at all those past webinars, audience members, and go devour James, David, and Bill's other good stuff. And if you want to get in touch with them, there it is right there on the slide. Their closing slide. There's the email. There's the website. So reach out to them with any questions. And we'll finish with this final question. Will you please elaborate on equity rollover options and or granting equity to key employees and the best practices to think about here?
So first off, equity rollover means that they already had equity before, right? So if they didn't have equity before, then it's not a rollover. If it's a rollover, then there's a few different ways to do it. Maybe they get partially paid out, maybe they don't. But we'll just assume that it's not a rollover because it's easier to answer if it's not. So if you're granting new equity to an employee, think about what the employee wants. Right? So best practices, some sort of vesting, frankly, is a best practice. But it could be that somebody doesn't understand the equity. That can happen a lot. So you may want to not do equity. You may want to do profits interests instead, slightly different for tax purposes. I don't like phantom equity. I wish it would go away. I think phantom equity is used to screw employees, and I don't like that. But what you'll want to do regardless, so have vesting in place and have sort of a repurchase formula, even for vested equity. So say that you give them profits interests and that they earn those over a period of years. Well, when they go to retire, right, you can agree in the employment agreement as to kind of how we're going to value any vested profits interest, and the company is going to repurchase those at termination, whether it's retirement or not. And it can be different whether it's for cause termination or not for cause termination as to how much you have to pay for that vested equity, right? That's a difference that can matter a lot, right? If somebody commits fraud, right, then you shouldn't have to pay them out, right? You should be able to basically grab it back for $1. But if somebody is retiring, this is a nice way to, go send them on their way. It's another reason I don't like phantom equity. Phantom equity, they wouldn't get anything under that world. But yeah, it's really just be clear about it. Use vesting and make it clear how you're going to repurchase when they leave. Those are best practice.
And one thing also I'll say about phantom equity is it gives a much worse tax treatment for the employee. They don't get long-term capital gains. So, it's I'm not saying that we haven't always we've never helped someone do it, but we like to see normal equity so that they can get that tax benefit.
And why is it that phantom equity can be appealing to the owner?
Well, partly because it's easier not to pay it, to be frank. And it also allows you to expense that when it's paid. So that effectively just becomes an expense of the company, which it wouldn't be. And again, it allows you to put in a lot of caveats. We've seen employees that weren't able to get phantom equity because the company was sold in an asset sale and not a stock sale. And that didn't qualify under the definition of change in control in the phantom equity document. So that's why a lot of times we are cautious about it, because we've seen situations where really the employee should have been entitled to it, but the employer, you know, didn't really follow the spirit of the law. And under phantom equity, you don't really have very much recourse at all. So, yeah, just things to keep in mind.
Great. Well, we'll call it there, guys. A lot more questions that we did not get to. So, James David, sink your teeth into that after the fact. But fantastic presentation as always, James David and Bill. And your answers for the audience's questions. Thank you for that. Thank you, audience, for your attention. And this concludes today's webinar. Bye, everyone.